What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at shares of Uber, where shares are trading today, and if this offers a good entry point for investors long term. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on May 22nd, 2026. So let's dive right in here to the past 1 year share performance of Uber, and within that time frame, shareholders received a negative 18.8% return. Comparing that to the benchmark of 26.5%, that does indicate a relative underperformance of shares of Uber, comparing that to the benchmark of negative 45.3%. On a year-to-date, 1 month, and 1 week basis, shares have also underperformed the benchmark. And you can see in that top graph there, shares are trading at or around their 52-week low. You can see a significant selling pressure really from October, November of 2025, significant selling pressure in February. That was after their Q1 earnings release, which did miss earnings and guidance as well, which the market punished. And you can see with that significant selling pressure over the past 8 months has caused the 50-day moving average in around February to early March, that 50-day moving average in the green crossing below the 200-day moving average in the orange, which does indicate a technical sell signal, which does detract a lot of momentum traders on the institutional side and retail side from going into Uber shares. But when we look at the relative strength index as well, shares of Uber are significantly oversold. So in the short run, it wouldn't surprise me to see a pop in shares of Uber. A few key points here I want to touch on. I'll start with that earnings per share. You can see the declines through 25, 26, and 27. The underlying business of Uber is going through a restructuring. I'll touch on that later on in the video. But with that heavy investment and also the significant amount of share buybacks that management has executed on, has compressed earnings and returns on capital as well. I'll touch on those points later on in the video, but the earnings per share decreasing and declining over the next 2 years is not something that we like to see. Again, this is as of the most recent report. We can see those numbers change if they scale back some of their capex, but let's see, time will tell. But when we look at the underlying fundamentals, sales are growing significantly at 18.3% over the past year. That is a significant outperformance both to the industry and to the benchmark. When we look at the profitability ratios on the gross margins, outpacing industry and benchmarks as well on gross and net margins, that net margin of almost 16%. But what's really intriguing here is that return on equity at 36.6%. Phenomenal, and management has a great track record of delivering returns on invested capital, assets, and equity to shareholders just based on how they allocate money. But a lot of those returns on equity and invested capital have actually come down through 24 and 25 because of the heavy share buybacks and the share declines, like we saw in the previous snippet there of almost 20% declines. That does compress returns and margins for the business. Let's see how that transpires over the next few quarters. But when we look at the valuation metrics on a trailing PE of 18, forward PE of 19.3, price to sales of 2.8, price to book of 5.9, with the underlying fundamentals growing and the business growing by any valuation metric, by any means whatsoever, this does indicate a value name below 20, below 25 on a forward PE for a value name is really at the level where we want to enter. But let's see, time will tell. The underlying business is growing and shares are trading at their lowest valuation metrics in company history. There are 57 analysts who cover Uber shares. They have an average price target of $104.89. That does imply an almost 46% upside from where shares were trading on May 22nd, 2026. The most pessimistic analyst has shares going to $70 per unit. That does indicate an almost 3% decline, with the most bullish analyst having shares at $150 or almost 110% upside. So that risk reward on the downside, comparing that to the upside does outweigh the downside. You can see there's really only one analyst that has a sell rating on the name, but never in the company's 12 months or in the history of Uber trading, shares of Uber relative to their target price has never had such a wide discrepancy. We've seen that a lot in previous videos with other companies. Really, this market rally that we've seen through April has really only been in a handful of companies, great companies with solid fundamentals, big tech names, the mega cap names that we all know, and check out my other videos as well. But when we see a lot of these companies having a wide discrepancy of where the market is pricing the company versus where the institutions believe the true value of Uber in this case is, a lot of these companies in the S&P 500, in the Russell 1000, Russell 2000 haven't really participated in this significant rally from really early April 2026. I do believe there's a catch-up trade and broadening out in the rest of the market, and Uber should be a beneficiary of a lot of these funds with the underlying business growing. Let's see if shares will catch up to that analyst average target price, which again would mean almost a 46% return from where shares traded on May 22nd, 2026. And that's what I was talking about before here. Never in the company's history, really from Q4 2023, that's when they really start to be cash flow positive business, reporting earnings, where you're able to have a lot of these valuation metrics. But when we look at those averages, obviously shares are trading well below their averages at their 5-year low, essentially at their company low since the company IPO'd way back. So we're seeing underlying fundamentals growing, yet we're seeing shares go down. Yes, I do know a lot of these risks that the company is facing, and we'll touch on in the last snippet of the video here, but I do believe risk reward, the reward really does outweigh the risks for Uber long term. Again, you have to have a long term vision for Uber, but even on a short term basis, like I said before, shares are really indicating an oversold value, which in the short run, whether that be a month or a few months, should have a short-term pop after the significant selling that we've seen over the past few months. But when we look at the underlying business, this is what I mean. Gross margins on a 10-year basis have trended relatively sideways, which is not a bad problem. Uber has always operated in a very low and thin margin business. To even have these 30+% gross margins is a testament to how management has delivered on a various set of circumstances. But look at that net margin, really in December of 2020 at almost negative 61% net profit margin. Fast forward to end of December of 2025, almost a 20% net profit margin. That is a very big swing and does indicate management has executed on taking market share, expanding margins, and increasing revenue. But what's really telling here is that return on assets, equity, total capital, and invested capital. Look at that return on equity at 41.4% as of the end of December of 2025. These numbers would actually be a lot higher if you'll see in a few snippets here, if they weren't buying back their shares as aggressively. I'm not wanting Uber to stop that whatsoever. It does indicate that management and insiders do believe that shares are undervalued, but with shares looking at that chart there over the past year declining almost 20%, you are having those compressions on these return metrics. But on an operationally efficient business, Uber has decided to increase revenue per employee, which is something that we do like to see operationally in a company. When we look at the financial statements, look at those revenues growing on a 5-year compound annual growth rate of 36.1%. You're seeing great trends in almost all of these metrics. Net income going negative. Look at those a few years back. Significant negative net income and net margins. And you look at those, I just want to point your attention to that diluted earnings per share. Look in December of 2022, a negative $4.65 essentially earnings per share. As over the past 12 months, we're looking at north of $4 of earnings per share. That is a significant swing, and we should continue to see these EPS numbers growing. I know we did see a bit of 26 and 27, but that is a lot of that is heavy investment in its AI build out, in becoming an autonomous vehicle aggregator. All points we'll touch on later on in the video. But in the short run, it is compressing those earnings per share numbers. And we just saw all the money and cash that Uber has generated not just over the past year, but over the past 5 years. And it's essentially hit its all-time high in cash and short-term investments. We ask ourselves, what are companies doing and management doing with all this cash? In Uber's case, they are doing two things we'd like to see. Really, we would like to see three with those dividends there, but I'm not expecting a dividend coming from Uber anytime soon. But they are paying down their debt, they're servicing their debt. But really, through last year and really Q3, Q4 of 2024, we see a significant share buyback. Considering Uber doesn't pay any dividends, that does offer a fictitious dividend, almost a tax-free dividend, as you're getting those gains in shares, not having to pay any taxes unless you realize those profits. But we're getting an almost tax-free dividend in a sense, and having those shares propped up. But with that significant amount of share buybacks, almost 6.5 billion, you are having those returns on invested capital shrink, especially when shares are coming down 20% almost in the past year. If we do see the shares increase in price, we will see these returns on invested capital, assets, equities, and total capital, and so forth, continue to expand and increase. And finally, here, I believe this is a very telling point for Uber as a whole. Less than half of their money does come from the US. That has trended downwards in the past couple years, just with Waymo, Robotaxi, and so forth, taking a lot more share in specific cities in the US. But in regions where that autonomous vehicle build out isn't as significant and strong in, say, San Francisco, you are seeing Uber take a lot more market share, and there has been litigation costs reduced, litigation issues and legal issues disputed and finalized, which now Uber is able to expand their business in certain regions. I do believe this is a very important point of expansion and growth for Uber long term. If they're able to continue to dominate and take market share in developed and developing regions in the world, you're not only going to see an increase in revenue, but we should see margins expand as well, especially if they're able to operate in lower cost jurisdictions, whether that be lower labor costs, fuel costs, or other input costs there. If management executes on its international growth strategy, even having a few billion in revenue boost these numbers, you will see a significant boost to the bottom line of Uber shares long term. So right now we're going to take a look at the good and the bad for Uber shares. I do believe the good in this case does outweigh the bad long term for investors. And the strongest bull thesis for Uber is its transition from a pure ride hailing company to an autonomous aggregator. And what that means is, rather than trying to own and maintain an entire fleet of expensive autonomous vehicles, Uber is positioning its app as the primary demand hub for various autonomous vehicle players, like Waymo partnership we saw a few months back. This allows Uber to collect a service fee while letting partners handle the capital-intensive hardware and maintenance costs that come with ride-hailing services. Uber is rapidly scaling its autonomous vehicle partnerships and is on track to operate driverless vehicles in up to 15 cities by the end of this year alone, further proving the viability of its business model in a post-driver world. We should also see margins expand on this. It is essentially just a service fee. They are able to reap the rewards of this revenue without having capital intensive costs of maintaining vehicles, for example, as other autonomous vehicle players will face. I do believe that this Delivery Hero acquisition, full takeover essentially of Uber for Delivery Hero, will come to fruition. This deal would give Uber a massive immediate footprint in Asia, Latin America, and the Middle East, regions where Uber's delivery presence is currently limited. So we just saw that previous snippet there, revenue by geography. We should continue to see more revenue coming out of its international arm, which should expand margins long term for Uber. By acquiring a major global player, Uber can neutralize local competition and create a more formidable global counterweight to rivals like DoorDash. As an example, folding Delivery Hero into the Uber ecosystem as a whole could yield economies of scale, helping improve margins in the delivery segment, which is actually a key focus of Uber's long-term profitability. The company itself has never really been in better health. You're looking at strong earnings, good capital allocation with healthy free cash flows. The company has the resources to continue its stock repurchase programs, especially with shares trading at their almost 52-week low. And it also allows them to fund strategic growth initiatives, like we mentioned, the delivery hero deal, without diluting shareholders. Uber One, which is the company's subscription service, continues to show strength with over 50 million members who are highly incentivized to remain within the Uber ecosystem for both mobility and delivery. Uber One being the subscription service, and we've seen other subscription and SaaS companies in previous videos have such high margins. This is just free cash flow, reoccurring revenue in the 80 to 90+% gross and net profit margins. Finally, we did see a lot of that institutional and analyst positive sentiments in target prices and the forward growth of Uber as a whole. Now, that's the good. The bad, I don't believe, is something that investors should worry about if they have a long-term view. In the short run, you are seeing that earning volatility. A lot of that is having to do with the share buybacks and share price declines of those shares that they've been purchasing. I don't believe that's going to be a long-term play for Uber as a whole. Now, the market is still assessing how quickly autonomous vehicle technology will reach mass commercial adoption and what the regulatory landscape will look like long term. Currently, these do present short term pressure on the stock. With better clarity, investors will gravitate more towards the name. And if the underlying business is growing, shareholders will always be rewarded if a business fundamentally is growing no matter what happens with their shares. So I do believe fundamentals are looking healthy. Valuation metrics are indicating that shares are trading very cheap right now. But hey, let's see. Time will ultimately tell if this investment will work out. Again, this is not investment or financial advice, solely for entertainment purposes. Just want to present to you guys the facts and some of my thoughts here. As always, do hit that like and subscribe button and stay tuned for the next video.